Hey there, it's me, Stephen Thomas, with Reports on Housing with yet another wonderful housing debrief. Thank you for joining us. Last housing debrief for the month of August. Sorry I was not able to do it last week. I was enjoying some time with my wife now that the kids are back in school. Shout out to Nana for helping out with the kids, as well as our daughter Michaela and her husband Sean. So, without further ado, I want everybody to just lightly tap on that like button. Take a sip of your coffee, go ahead and tap that like button and subscribe to our YouTube channel. That just helps with the YouTube algorithms and make sure that as many people as possible get to see what's really going on with the housing market without listening to all the white noise and the clickbait sites that are all out there. So we're going to do this one this week. We're talking about housing slowing as rates rise. Now, the month of August, pretty much a wrap after today. There's been a lot going on as far as mortgage rates are concerned and the housing market. So the month of August has been quite the month. And the backdrop, everybody is acutely aware of the Federal Reserve. As a matter of fact, they met this last week. They were in Jackson Hole, Wyoming, and the Federal Reserve President Jerome Powell had a speech, and he basically stated that the same thing we've all been hearing over and over and over again. They're going to keep rates high, and they're going to keep them at where they're at. And if there are any changes, they're very data dependent. They keep saying this over and over again. So as a result, prior to them even having that speech on Friday, he's been saying this for a while. And as a result, we've seen some changes as everybody stops listening to the Fed and starts really honing in on the data. And you could see what's happened in the month of August. And in the month of August, we've actually watched the 10-year Treasury. And I need to explain something. The reason we follow the 10-year Treasury is because the appetite for the investor that's looking at 10-year Treasuries is the same investor that's looking at 30-year mortgage-backed securities. And when 10-year Treasury goes up, mortgage-backed securities tend to go up. So we saw interest rates go up. And so same thing happens. 10-year Treasuries come down. We see interest rates come down. So that's why we watch it. It's what is referred to as the spread between the 10-year Treasury and the 30-year mortgages, and it kind of dances with each other. For a very long time, you can go back to 1971 when they started tracking that stuff, and you could see that they've been jiving together for a super long time. But you could see where we're at as far as the 10-year Treasury is concerned. This was earlier today, and we're at 4.112%. And you could see that since April, it's been a slow, methodical rise from April through May, June, July, and then August, we saw quite the peak. But if you actually look at between the end of May through the end of July, so it was the very end of May all the way through July, not much was happening in the 10-year Treasury. As a matter of fact, we were watching interest rates kind of hovering around the same thing. The same thing was going on with the 10-year Treasury. Really was not changing much. And then along came August, and August is where we saw an absolute surge in the 10-year Treasuries to the highest level in a super long time. And here's part of the reasons that we saw this big change. First of all, Fitch Ratings came out and they they changed the credit rating for the United States to AAA to AA plus. And not a gigantic change, but what they're saying is they don't like how Congress is going about with the United States debt. Also, there's this debt ceiling that's constantly changing. So there's a lot of balls in the air, and they don't like the way that things are going. They don't like the fact that there's a giant deficit that keeps on ballooning. So as a result, with all of that and the way that Congress has been acting over the course of the for quite some time now, but it's really come to an acute point because we're going to be hearing it again, this debt ceiling thing. So this has, as a result, Fitch Ratings changed the credit rating for the United States from AAA to AA plus. That was on August 1st. That's where we started to see a change in the 10-year Treasury. Then on August 4th, we got a jobs report. The jobs report actually was a little bit less than expectations, but it really didn't matter when you were looking at it. It's still the overall job market. We haven't what economists or the Federal Reserve is really liking to see is the fact that that the jobs really start to come down. They're a lot lower, and we see unemployment rise as well. As you can see, unemployment here is about 3.5%, and the lowest ever, not lowest ever, lowest in decades since 1969 was just a few months ago at 3.4%. So unemployment is at decades lows. And that has fed into an issue. Part of the problem is that we're adding 4 million workers per year, but we're also seeing 4 million United States citizens retiring. So net is zero. We're not really seeing us add anybody to the job ranking. So it's created quite a stir as far as jobs are concerned. And the job market is extremely healthy right now, which is why you're seeing a lot of strikes and more strikes to come. And the automobile workers are about to strike. We've seen it with Hollywood strike, and there's UPS was going to strike, and there's a whole bunch of other strikes that have been going on. So on August 10th, we had the Consumer Price Index come out. Now, if you look at it, headline is that aqua colored actually went up a little bit, but the core is coming down. But still, for a lot of for the layperson that's out there, they don't like what they're seeing. They want this tenured. They want to see the CPI come down quite a bit, back down to the 2% threshold that the Federal Reserve would like, and they're not happy with how long it's taking to come down. But there are not that many people like myself that know that this is going to come down, that you just need to be patient, that economics is just, it takes a long time, it's boring for most people, not for me. I like the nuances of watching it on a day-to-day, week-to-week basis and how it changes over the months. And this is normal for somebody that just tracks this all the time. So I'm actually not that concerned. But apparently everybody doesn't like how it's not coming down fast enough, and they talk about it like crazy because it takes another month for the next one to come out, and there's a lot of talk in between about what's going on with inflation. And then you have on August 10th, as a result of that credit rating and a few other things, now the United States dumped a whole bunch of treasury bonds on the market on a Thursday. And that Thursday, August 10th, it didn't go as well as they thought. And as a result, we saw the treasuries, the prices actually, they got a lot more favorable. So you could actually make a lot more because there wasn't enough demand. So demand was a little bit weak at that particular treasury bond auction that took place on August 10th. Then on August 15th, we got retail sales. Now, retail sales missed expectations. It actually wasn't a negative on it. It was too high. It beat expectations, not a miss. Beat expectations on August 15th. It was too robust, too strong. And as a result, that was just one more thing that just added to this narrative that the overall United States economy is just too hot and it's not going to cool anytime soon. And as a result, everybody started talking about it's going to be higher for longer. And that's what everybody is talking about. If you're listening to all the different talking heads on CNBC, on Wall Street, YouTube channels, they talk about higher for longer. That's what it's all about. And the more that people talk about it, the more that people get a little scared and they wonder, this is going to take a lot longer than what we originally thought. And as a result, the bears came out, and when the bears come out, you're seeing this change, and this happened in bonds over like the course of the month. They're thinking that the Treasury bonds are going to be a lot higher than for a lot longer, and that it's going to take a lot longer for the Fed to eventually come down to start to pivot and come down in rates. If you remember back at the beginning of the year, people thought that by the time we got to the end of the year that the Fed was going to pivot and that the short-term rate that they control was going to be going down. Now, where everybody thinks it's going to be is not till June of 2024. So all of this has been stirring around over the course of the past month. And as a result, the 10-year treasuries follow mortgage rates, and you could see mortgage rates right now are at 7.07%. Now, from April about when they were about 6.2%. I think that was 6.18% on like April 1st or right around there. It went all the way up, and you could see this slow, methodical grind up. That was very, very similar to the 10-year Treasury. But you can also see that from the end of May through, actually through the end of July, not August, you could see how it was kind of flat. It went way up higher for the month of August. And right now, it's at that 7.06%. But it really climbed in the month of August. And on August 22nd, that was a week ago, I believe on Monday, yes, or actually Tuesday. So a week ago on Tuesday, August 22nd, interest rates hit 7.49%. It was the highest interest rates had been since 2000, since the year 2000, November. So November 2000 was the last time we had interest rate as high as just about 7.5%. So that created quite a bit of angst out there. Now you can actually see this in demand. With interest rates as high as they are, we already have an affordability issue, and going from where we were about 6.75, making our way to 7, all the way up to 7.5%, now it's really starting to affect demand. And we can see it in the demand numbers. But first, I would like to thank our sponsor. Our sponsor is JJ Mazzo at the Mazzo Group. He's the executive vice president at Cross Country Mortgage, and they're #1 retail lender nationwide. Scotsman Guide nationally ranked top 200 mortgage originators over 25 years, plus over $2 billion personal home loans funded. JJ's been around. He's got loads and loads of experience. They have a program called Rescue 911, and the reason he has that is because he's able to put together a lot of deals where others can't. So if the terms you were given initially are no longer honored, or your lender has gone dark on you, or figures keep changing, multiple requests for paperwork, that's where he can help save the deal. If you need a home loan rescue, you can call them now at 877-237-9694. They have a same-day approval. They close in as little as 10 days with their 1,000 per day guarantee. And I would like to talk about how we at Reports on Housing, we're going to have our very, very first forecast, and this is open to all agents. If you look at that QR code, you can RSVP, and I am going to be delivering our very first 2024 Orange County housing forecast. Now, we're going to be doing forecasts for all different areas, but the very, very, very first forecast we're doing is for Orange County, and it's on September 26th from 12:30 to 2 at Marbella Country Club. And you can reach Mazzo Group at 877-237-9694. That's 877-237-9694. And you can go ahead and take a photo of that. You take a picture of that QR code, and it'll bring up the link so you can sign up. So thank you again, JJ Mazzo and the Mazzo Group, for your continued sponsorship. Now back to demand. Now with mortgage rates going all the way up towards 7.5%, you can imagine what's happened when I take a look at what's happened for like the last 30 days in demand, pending sales activity. That's how we snap it. We look at pending sales activity. So what's happened is it's actually down 8% since the end of July. And that is a bigger drop than what's normal. Last year we were up 5%. In 2021 it was down 1%. In 2020 up 1%. And in 2019 down 3%. So an 8% drop is a little bit more than normal, and that has a lot to do with where mortgage rates went for the month of August. And let's also, we've talked about the impacts on demand. I do need to talk about housing inventory as well. It would only be fair to talk about what's going on with the lack of homes that are available. So today it's at 21,112. That is up 4%, or 746 additional homes. In 2022, it was down 1%. It had already peaked. In 2021, it already peaked, down 2%. 2020, down 3%. And in 2019, down 5%. In 2018, I show you this. It was actually up 5%. Sounds very similar to this year, but that was 2,112 homes, and that was in 2018. It's actually not on this chart, but I just wanted to show you that 4% of a small number is only 746 homes. So that's what we added in the last since the end of July. That's been the overall change. And it typically peaks, the inventory right now typically peaks between July, most likely the middle of July, all the way to the end of August. And it looks like we might have just hit a peak because it kind of flattened out over the last 2-week period of time. So it looks like it's flattened out. Now from here, we could, if it does peak, it goes down. Now what I'm actually hoping for, and the reason for this is because we're following the red line, which is 2021, which set up the orange line, which was 2022, which is record low numbers of homes in Southern California and across the United States, a record low number of homes available to start the year. That's what it's looking like for 2024, and that's not really what I want to have happen. So what I'm hoping for is a little bit of a delayed peak, and then we come down so that we can have a few more homes than where we started off 2022, that orange line. But it's not going to be enough. We just do not have enough time towards the end of from here to the end of the year, and it's seasonally when fewer homes are coming on the market. And as a result, what we're really dealing with, we are dealing with demand, and demand actually went down a little bit more, but we're still dealing with the scarcity of homes available to show buyers right now today. The speed of the market, if you place your home on the market, when are you opening up escrow? We were traveling at about 100 miles per hour. It was very, very unhealthy. The overall market is still unhealthy, but I'm going to remove a couple of berries. It's not very, very unhealthy. It's just unhealthy. We're still moving at a pretty fast pace. And depending on your market, there are markets that are still absolutely at insane, very, very unhealthy paces. But overall in SoCal, you're looking at today, it's at 64 days. It's up 8 days since the end of July to where we are right now today. And in 2022, it was down 5 days in that time period. You could see that orange line above. In 2021, it was the same over that same period of time. And in 2020, it was down 1 day, and in 2019, down 2 days. In 2018, it actually went up 10 days. So that's where we're at. We actually slowed down considerably for the month of August as to what's comparable, what's normal, and a lot of that has to do with where mortgage rates were for the month of August. Now, where do I think things are going to go from here? There's a lot of people that actually think that we're going to go up from here. It's going to continue to go up. It's going to continue to slow down, but that's not typically what happens. What typically happens, you can see it in the purple line, the green line, and the red line. That didn't happen in the orange line, but it was last year. That's when interest rates kept on going from August all the way to October, November, where it peaked out at well into about 7.35% is where it peaked out at. And so it really slowed down considerably. Like from the start of August to October, November, you saw an over 2% increase in interest rates. That really slowed down the market. We saw a buildup in inventory, and the expected market time increased. That's not normal. What's normal, you can see in the red line, flat, green line, 2020, flat, 2021 was the red line. And in the purple line, 2019, pretty flat. Kind of can change at the end of the year, but that's most likely what we're going to see. And you're wondering, Stephen, I thought you said that the demand had slowed down because interest rates are up. Isn't that going to continue to be the case going forward? But let me tell you, I do my math. I do all my homework. I look at all the data and facts and just deliver to you guys data and facts. And really, at the end of the day, the 10-year Treasury over the past week has really dropped considerably, especially this week. And you could see that giant drop because there it was knocking on, it was making its way well up there, well above 4.25 for the United States 10-year Treasury. Now it's making its way back down towards 4. Right now it's at 4.112 when I snapped this. And this from a week ago, let's see, so Tuesday of last week, August 22nd, we were at 7.49%, and it's all the way down to 7.06%. We're already shedding almost 0.5% in such a short period of time. I'm not used to this, and nobody should be used to the volatility and interest rates going up so much and then coming down so quickly. That's not normal. That's not what a normal market looks like, but it just shows you when you're in uncharted territory that there's a lot of movement in the market. So you can't expect things to be the same as they were yesterday or last week or the last month, that things are constantly evolving and changing. But there were some reports that came out over this past week that are very eye-opening, that kind of paint that the economy really may be slowing down finally, which would bode well for mortgage rates. 10-year treasuries would probably, 10-year bonds would go down, as well as we would see mortgage rates go down. So the 10-year coming down, mortgage rates coming down, and that's kind of what happened on Wednesday, earlier this week. I think that was Wednesday. It was yesterday. Job openings dropped further. They dropped all the way down to 8.827 million. Now they reached as high as 12 million. You can see that they were at 12 million for a while, but this is the lowest level since March 2021. And if you look at it, the Federal Reserve really wants to see this have a 7 handle on it. They want to see it get under, it's somewhere into the 7s, below 8 million. And it's making its way towards that. And as a matter of fact, so that was for this past month. The prior month, they revised it down for job openings. So job openings, you could see that overall, where are we headed? It's getting a little lighter, and that is extremely important. And similarly, the number of resignations, quits, is down as well, which means that people are staying in their jobs. They're not necessarily moving like what we heard, that great resignation. That's no longer kind of happening. It's really starting to slow. And ADP had their employment report that came out, and the ADP employment report came out, and it said that it was 177,000 jobs that were opened up. Now, this is down from the last couple months where it was a lot higher than what was anticipated. That also factored into what happened last month. Although I'm not a big fan of ADP's employment report, there's a bigger report that comes out, and that's on Friday. So jobs report, super important. And something else that I wanted, consumer spending might be up this last month, but you have to understand that student debt, they all got their notices. Anybody that had student debt, they didn't have to pay their student debt back. It had stopped. There was a moratorium on it. Didn't have to pay it, and then all of a sudden now they have to pay it again. And in August, this last month of August, they got their notices that it's due in October. So they're going to have to start paying back their student debt again in October, which is going to eat into consumer consumer spending. So we've got to keep track of jobs. It's very, very important to keep track of jobs. And jobs reports coming out Friday. If this comes in a little bit lower than expectations, you can watch interest rates and the 10-year continue to drop even further, and we might get interest rates all the way under 7% tomorrow. We'll have to wait and see what happens. But what happens when interest rates go down? Demand rises. When interest rates go up, demand kind of weakens, and that's because of the affordability. Already things are unaffordable, but when you go from where they were recently at 6.75% all the way up towards 7.5%, well, they're coming back down to 7%. We'll make our way down into the 6s if the economy cooperates and it isn't as hot as it's been recently in reports. And you can understand demand rises. And you can see that with any affordability scale. I show this to a lot of people out there so that they understand. We were at 7.5% nearly last week. And if you want $4,000 per month principal and interest with 20% down, it doesn't include insurance, taxes, or homeowner association. It's just principal and interest. You're able to afford a home at $715,000. Dropping down to 7%, now you're able to afford a home at $751,000. And if we get down towards 6.5%, which we've been there earlier this year, you're now looking at nearly an $800,000 house. That's a big change from where we were just last week. And so you can imagine that what happens is demand continues to increase as interest rates drop. And that's what we'll be watching for the month of September. If we continue to see this, we've peaked out, and that was the highest level for 2023 was earlier in August when we got to that 7.5%, but since then we'll come down, and maybe September come down a little bit more. That will bode well for demand. We'll have to stay tuned and wait to see how all the numbers work out, because we're all data dependent. We're not listening to the Fed as much. We're watching the data to see what it says. But overall, when they did as much as the Federal Reserve did with interest rates, with short-term rates, there's headwinds that are coming our direction that slowly but surely we're going to see it in the commercial real estate arena. We're going to see it with different businesses. You're going to see it with bankruptcies and things like that, where there's going to be some headwinds that are going to slow down the economy enough where people will keep their jobs. Job market will still be strong, but it won't be as robust as it's been over the last couple of years. So that, and unemployment may rise just a bit, not much, because I told you there's 4 million people that are retiring per year and 4 million entering the job force, so net is 0. So we're not going to see giant changes in the job arena, but we're just going to see it not be as strong and robust. That's looking like the direction that we're going. If you want a copy of this, you need to be a subscriber to one of our many housing reports. We have housing reports for each county in Southern California and up in the Bay Area report. You go to reportsonhousing.com. You'll get the most recent one that came out called Lower Ranges Fading Away. Did an analysis and showed how some people are so used to these lower range price points, they're now gone or deteriorating. So if you would like a free month, subscribe. Utilize the coupon code JOBS because Jobs Friday is just around the corner. It's tomorrow, for a free month. So, and also stay tuned. We're going to be taping our Housing Debrief, our 3rd episode of Housing Debrief. You can find it on anything you want. Spotify, you can find it even on YouTube. Just look around for it. It's all over the place, and we just launched it. 3rd episode we will tape tomorrow, and we will deliver it next week. But I just want to thank you for tuning in to another Housing Debrief. Thank you for joining us. I hope you have a great finish to your week, and we will see you on the other side.